Right, let's get started, everyone. Good morning, everybody, and welcome to Gulf Intelligence Daily Energy Markets live video podcast on Friday, the 14th of April. Just a little bit of self-promotion here, if you don't mind. Note the banner behind my head. This is my new role as editor-at-large of Arabian Gulf Business Insight. Please check it out, AGBI, just don't call it AGBI. Okay, the plug is over to business here today. Brent crude is at $86 and a bit, maintaining a slow but steady climb after the shock OPEC cuts of early April. We're still digesting those cuts, and I've got with me three experts, well-known faces on this show, to give us some interpretation and analysis of that, with much gossip, speculation still reverberating around, though not so much in the price, I have to say, which has been fairly even and controlled in its ascent after the initial spike. There's certainly been no sign of the spike up to $90 so far. Meanwhile, the OPEC monthly report published yesterday showed unchanged demand growth at 2.3 million barrels per day, which begs the question, I guess, of why they announced a 1.6 million barrel cut just a couple of weeks ago. Let me go first to Jorge Montepec, President and founder of Global Markets, to answer that question. Jorge, we've had plenty of time now to digest the cuts, so give me your considered take on that. And also, can you square the OPEC Plus circle about cuts and projected demand?
Well, I think OPEC, as it is in their job, is to balance supply and demand, and very importantly, consider the impact on its revenues. And the revenues for OPEC were coming down as we headed into the end of Q3. This is the impact of the steady and unrelenting rises in interest rates. One is never sure about the impact of interest rates other than they decrease economic activity. And I think we have seen that globally. The impact is severe because the mortgages that people had to pay suddenly doubled in many cases, if not more. And as you divert your income into mortgage maintenance, your disposable income declines. So for OPEC, they had to consider that maybe the impact on oil consumption would be very, very large, and they needed to get ahead of the curve, and the oil prices were actually not cooperating. If you take that into account as to how the market has absorbed it, is the fall in prices stopped, the prices have started coming up, but they have not hit 100 yet, which is what we expected prior to the cut. Okay. So if we had been right in our expectation that oil was heading to 100, then oil should be like 110 or 20 with the 1.6 million barrel cut. So
okay, but it hasn't got there, Jorge, has it? And you know, I mean, I understand what you're saying, but how then do you explain the unchanged OPEC Plus forecast for this year, still 2.3 million?
I think these are economists looking at issues from one point of view and another set of economists looking at another objective. And I think it's more the market people looking at the revenue for OPEC. They really need to worry about that. But let me go into why I also think that demand is not shrinking. While the Federal Reserve has been increasing interest rates because of rising inflation, it is clear that the most recent data is showing that inflation is slowing down on a year-to-year basis. So while prices are still going up, they're going up at a much lower rate than last year. So the second-degree derivative is already negative. And this is because if you take any commodity that you can think of and you compare it year-on-year basis, the price is either even or much lower. Look at the price of LNG is lower. The price of copper is not screaming up. Everything is lower than last year at this point.
We had a big spike last year, of course, because of the war.
Correct. And it cannot keep spiking at the same level, right? So we are having lower inflation. So if you think as an economist, and I think OPEC has plenty of that, right? Is you will see that inflation, the rate of growth is slowing down. And therefore, this has to impact Federal Reserve actions, and that they will not continue to increase interest rates at the same level they were. And one even needs to consider the possibility that they could cut by the end of the year. So if this happens, then demand for oil will continue to go up. But let me bring you to one key point, and then, of course, you carry on. The exports by China, as released 2 days ago.
Yeah, they were big. Yeah.
They were huge. And the nearly 15% increase in exports occur while exports to Europe and the US decline. That means that torrid, hot growth is because of consumption in what I call, and we all call, the global south. So demand from Latin America, Asia, Africa is overwhelming the previous torrid demand in the West. So the world is resetting in ways that we cannot imagine, that are not obvious to many of us yet. But what that means is that oil demand in the global south will increase massively this year.
Okay.
And that's another thing for the OPEC numbers.
Thanks, Jorge. Let me go to Rad Al-Qadiri, Managing Director for Energy, Climate and Resources at Eurasia Group. Rad, I want to devote some time a bit later on to the geopolitical aspects of the cuts. But tell me, from your point of view, the market trading aspects here, and in particular, the imbalance, it seems, between OPEC forecasts and OPEC cuts.
I think you want to put OPEC forecasts to one side. I think that the two things drove this sort of initially. One was, I think the market was betting against OPEC in the short term. And OPEC was keen to squeeze the shorts in the market, which it did very effectively. You saw a market that changed from fairly bearish into bullish, or at least the beginnings of bullish, rather quickly. But I think it is worried about demand in the longer term. And some of the commentary that went along with those numbers indicated still a concern about sticky demand as a result of the Fed moves, but also some concerns over China, and a sense that China possibly hasn't picked up with quite the pace that was anticipated. Now, I think, we still have some way to go this year. The second quarter last year was obviously extremely bad in terms of demand destruction in China. And I think, just as in the West, when the COVID restrictions were lifted, what you are seeing in China is a gradual return. China's growth policy this year, though, is still relatively modest, and it's focused very much on domestic consumption, and sort of that isn't necessarily guaranteed to underpin, especially middle distillates. I think the expectation is you're going to see that rises in demand on the jet fuel side. So I think OPEC is approaching this cautiously and doing something it's done for 30 years. Which is to be proactive when prices are on the downside and reactive when they're on the upside. And OPEC has managed to change that dynamic. As you said, there's this gradual increase. You had the initial spike. Going in, we're in the second quarter now, and prices are still sort of in the mid 80s and above, which is not a bad place to be. We're only a few dollars off, I think, where we get into the Saudi and OPEC plus Goldilocks zone of $90 a barrel Brent. So I think all of those factors are coming together. But what OPEC is saying is two things. Don't bet against us, and we want higher revenue, and we're willing to take measures to defend that higher revenue.
Okay. Adi Imsirovic, Director of Surrey Green Energy. Rad touched on that just then, but the other bit of narrative here is that the cuts were aimed at shaking out speculators and shorters from the market. I know Prince Abdulaziz doesn't like them. He wants to make them ouch, as he said. But was that the main motivation for the cuts, do you think? And also, Adi, how do you square this circle between OPEC Plus forecasts on demand growth and the cuts? You're mute, I think. We can't hear you, Adi. Are you mute? Is your volume turned down or something? No? Can't hear you here. Sorry, why don't you try and sort that out? And
Adi, if you can relog in, please, so that you can have the audio again. Sometimes this glitch happens.
Okay, yeah. Okay, we'll come back to Adi then on that. But I want to also ask about, we've seen some pretty gloomy news from both the IMF and the Fed minutes earlier in this week, both raising their assessment of the chances of recession this year. Is this a factor in the so far, muted response to
can you hear me now?
Price cuts? Yeah, we can hear you, Eddie.
Okay.
So,
yeah, sorry about that.
Let me pull you in for that question then.
Sure.
We've seen some fairly pessimistic news from the IMF, from the Fed this year, both increasing their assessment of the chances of a recession later in the year. Is this a factor in the fairly muted response so far in terms of price to the oil price cuts?
Flushing out the shorts is just an excuse. It's just an excuse. I would agree with Jorge. It's all about revenues at the end of the day. And it's interesting. I think what's very interesting to see OPEC, well, we've seen it in the last 3 or 4 years with the political change that especially the leaders of OPEC, Saudi Arabia, is very much short-term, maximizing revenue oriented, rather than the old-fashioned Saudi Arabia that looked at the long picture over decades. Okay. In terms of the OPEC report, what they say in the report, oh, well, if I recall well, they are talking about rising inventories, which is bearish, summer demand uncertainties, which is kind of either bullish or bearish, but then they're saying that, well, US bank failures will probably have very limited impact anyway. So the bottom line is that, let's face it, they don't have a clue. And I don't blame them, because very few of us understand actually the impact of these recent financial troubles. Almost certainly, according to the people in the know, i.e. IMF and the likes, who are saying there will be some contraction in terms of credit, and that will ultimately have an impact. Because people, look, in simple English, people are going to be a lot more careful what bank they put the money in, and the banks will be a lot more careful who they lend to. So essentially, it's a big unknown. The other problem on the supply side of things for OPEC, and hence the voluntary cuts, is that you're opening, as soon as you're doing change in the output, you're opening a Pandora's box of quotas. So in reality, a cartel would sit down and say, okay, well, we have to cut by 1.5 million to balance the market. So you cut this much, you cut that much, and so on. That's a Pandora's box, always has been since 1960 when OPEC was formed. So right now, what's going on is they're saying voluntary cuts, and we know how that works. It's going to be Saudi Arabia will probably do the brunt of the cut, and then we'll leave it to the others. Of course, now we are moving on to OPEC Plus. So what is OPEC Plus going to do? And plus being really Russia. So, and we know with Russia, my point would be that Russia will never, ever do anything to reduce their revenues. In the current situation with the war on, the 500,000 barrel cut that Russia announced is simply because they anticipated issues when the product's price cap was phased in.
And we haven't seen
February.
those cuts yet either, Adi.
No,
have
we haven't.
Come through?
In March, our sort of exports increased. So that's my point. I think exactly that's my point, that Russia is not going to do anything. Russia will basically maximize their revenues because gas was always their political leverage and oil is the revenue for Putin. And he will not do anything to jeopardize that revenue. He'll do everything to maximize their revenue, including Joe boning the price, but also the cut being announced because they did anticipate that the product's price cap would impact the product's export. Russia has to do a lot of shifting internally because oil is more fungible than products. Its oil is easier to move longer distances because of ports, because of infrastructure. So internally, Russia has to produce more crude oil, export more crude oil, and actually produce less products. So that's a big configuration
Right.
for one of the biggest players in the world.
Yeah, yeah. There is a full ministerial meeting of OPEC Plus in June. That's the next scheduled one, and maybe there will be some renegotiation of baseline volumes there. And there could even be further big news of more cuts. Who knows then? Jorge, what's your feeling on that? The next big set piece of OPEC Plus is in June. Will they cut further? Will they increase?
I think they will have two options then: to keep production at the same level, or if they detect a strong surge in demand and prices above 100, to then restore some of the production. All the data coming in so far is that demand in Europe and the US, in the northern part of the world, will be muted because of the impact of the interest rates. But I generally think that in the global south, they're more accustomed to dealing with an inflationary environment and also with high interest rates. So for them, it's more marginal to change, because when you go from 10% to 12%, it's not as dramatic as going from 2 to 4, where you have a 100% increase. So I mentioned earlier, this is the rebalancing. So I think by June, we will be in the middle of the summer demand. Then it will be clear that supply is not keeping pace with demand. Do not forget the very important point that the US ability to flood the market and compensate on the Russian cuts or impact of them is diminishing by the day, because their inventories are less than half of what they used to be. So
I'm glad, Jorge, that you mentioned the US, because that was the kind of next area that I wanted to look at. There was a big piece yesterday in Bloomberg, written by the economics editor, and he was talking about the US-Saudi oil pact is breaking down as Russia grabs the upper hand, was the headline. An empowered OPEC Plus, led by Saudi Arabia and Russia, is calling the shots on oil prices, boosting inflation and raising recession risks. Rad, tell me about that. This is kind of a narrative that has been developing. I think this Bloomberg piece yesterday was probably the clearest restatement of it, the clearest summary of it that we've seen so far. Is the deal between King Abdulaziz and FDR in 1945, is that dead?
I mean, I think this is a case of economics catching up with politics. And quite frankly, I think the Bloomberg article way overstates it in simplistic terms. I mean, there's clearly a new narrative and there's a new set of policy directions in Saudi Arabia. And that is about, as everyone's mentioned so far, focusing domestically and the need for domestic revenue for very ambitious sort of growth plans, ambitious diversification plans, but plans that nonetheless, in the long term, are going to be reliant on oil revenue. And I think you have a variety of things playing into that. I think the Saudis believe that the global economy can sustain a higher price. But they want the revenue. And what they're essentially saying, I think, is that you, the United States, are a relationship we have, but you are one of many. And we are going to diversify our relations. I think, going back to 2019 and the drone strikes on Abqaiq, which led to no meaningful US response, the question of the credibility of the US security guarantee was eroded somewhat. Red lines between Saudi Arabia, well, what were red lines for Saudi Arabia and what are red lines for the US are clearly different. There's tension with the Biden administration, and there has been from the moment it came in. But fundamentally, this is an oil-producing state saying, I want to maximize the return on my investment, and I'm going to take measures that are needed to maximize those returns on investment. I need the money as a country, and I'm going to sort of work to maximize that monetization. I also think it's reflected in part, and this is marginally, uncertainty over longer term demand as we go through energy transitions. And, the Saudis, just like every other Gulf state that has hired fancy consultants, are being told, you need to monetize quickly. Demand is going to run out. I don't necessarily believe that view, but I think it goes into this notion. And the Saudis are in the best position they have been in 30 years, really, to manage markets effectively and to take advantage and be able to influence them. So I think we have a combination of factors where the US has its interests, the Saudis have theirs. Where they align, I think you still have a strong relationship, but it's quite clearly that those relations are diverging. And for the Saudis, looking east is your long-term future. And if that comes with compromises on your relationship with the United States, so be it.
Okay. Kim Gassas, a well-known author and journalist, recently said that it's not realignment by Saudi Arabia, but it's non-alignment. That they were choosing a completely independent path. Andy, let me just read to you briefly what another journalist, Bradley Hope, former Wall Street Journal journalist, what he wrote recently. Saudi Arabia is, for the first time in its history, an independent country with a leader who makes decisions with an absolute Saudi first mentality. It's been more than a generation since an Arab leader emerged with such sureness of purpose and ruthless edge to achieve it. Ruthless edge. What do you think of that?
Well, it's very hard to disagree with that. And first of all, I think I would also agree with everything that Rad said. But now we have to talk about consequences of that. I mentioned early on already that Saudi thinking has very much changed from long-term old-fashioned oil for decades into literally year by year or month by month of managing to maximize the oil revenues. The problem is with that policy. That policy is fine. I mean, obviously, Saudi first. Policy is fine for Saudi Arabia. There's nothing wrong with that from the Saudi point of view. The problem is twofold. One, you've got OPEC becomes a destabilizing factor in the market globally rather than a stabilizing one. Not that they ever were, but essentially they're becoming very destabilizing because in a situation where you have a possible recession, and we are at the brink of recession pretty much everywhere in developed world and developing world, having high oil prices will just now, when as Jorge said, that sort of central banks may want to reduce rates when they would like to reduce interest rates, they can't because they've got high oil prices and probably high inflation. So that their latest decision by OPEC to do a major cut will probably induce these interest rate cuts, if they were ever on the cards, or at least a slowdown in the increase, not to happen, pulling the whole global economy into recession. And I think in the latest reports in April here, IMF have sort of spelled that out pretty well. So that's the main problem. It's a destabilizing factor, and it's actually, from the economics point of view, short term, because if we do have a major recession this year, oil demand is going to fall again. Right. And then again, there'll be fight for prices. And then OPEC Plus is going to be in a very, very difficult situation because they already...
The situation will change, yeah, of course.
Exactly. So markets work.
One question here, which has puzzled me for a long time. Saudi Arabia within the OPEC Plus organization seems to be enabling Russia, if you like. But Saudi and Russia are now direct competitors for Asian crude, aren't they? And Russia seems to be grabbing market share big time there from Saudi. How will this pan out long term? You know, how can Saudi be sanguine to hand over market share to Russia, you know, with regard to China and India, big consumers in Asia? Jorge, what do you think of that?
Well, the Saudis are extremely commercial. And if you look at their balances, they are increasing as direct investors the consumption of oil massively within China and Asia, because they're investing, buying refineries. So they're buying secure outlets. So you could take a point of view that they don't need to worry about any other competitor because they have a secure outlet, and they do.
Okay.
The other is that they are commercial. And you can see that right now. This is a very good example right now. The reason Russia is grabbing a greater market share in Asia is because Europe is willing to pay more for the Saudi oil. Because Europe has the sanctions and they don't have access to the Russian oil, they need Middle Eastern and American oil, and they're paying for it. So if you're commercial, you have to choose where you go. So it wouldn't be out of the realm of possibilities that Saudi Arabia itself becomes a customer for Russian oil in its Chinese refineries. And they should do that, just measure what gives them the best value. But I wanted to add something to what you discussed earlier. The changes we are seeing in the relationships of Saudi Arabia are extremely, in a way, predictable and simple to see. The West, for many years, has been telling Saudi Arabia and other countries, your oil is bad for the environment, we hate it, we will work very hard to not consume it, and that means that you, Mr. Supplier, you're gonna die. Meanwhile, China is saying, we need your oil, we welcome your oil.
Yeah.
We want it. So what do you expect Saudi Arabia to do? To be allied with the one that says, we are going to kill your market, or to be with the one that says, come here and let's have some tea together, right?
Okay. We're approaching the end. I want a little change of pace, if you don't mind. Let's talk about energy transition, climate change. We have a survey question here, which talks about the references really the upcoming COP28 meeting in Dubai in the UAE. But this has caused a great deal of controversy around the world. Lots of the NGOs and environmentalists don't like the idea of it being here. Dr. Sultan Al Jaber, the president of COP this year, and also the CEO of ADNOC, of course, has been going on a media offensive recently, giving interviews to various Western organizations, explaining his position as a transactional, business-like president of COP28. But I don't think that will satisfy the activists. So my question to you is, to choose a yes or a no, can the oil and gas industry expect to earn a seat at the COP climate solution table after we've recently seen European oil majors join US peers in backing away from energy transition commitments? Let's have a single choice there. What do we think? Are oil-producing countries the right place to stage a climate change conference? Adi, succinctly.
Yes, I think there's no reason why they shouldn't be. I think they are they're a problem, but they are part of the solution as well. So there's absolutely no reason why they shouldn't be there. I think Dr. Sultan Al Jaber has said all the right things that any sort of well-meaning environmentalists would want to hear. Now, whether that's just a PR or whether that's, truly meaning is another question. Nobody knows. But I think there's absolutely no reason why they shouldn't be there. And I think that they're a part of oil industry is a big part of this solution.
Right. Rad, what kind of COP do you think we'll see in the UAE later in the year? Will it be an oil company business fair? Will it be a meeting of indigenous peoples? Will it be a protest fest? I don't know. How do you think it will look?
I think what the UAE is signaling is it does want the conversation about oil and gas, but it wants the conversation about oil and gas within the context of energy transitions, which is a very sensible solution. Really, what kind of COP it's going to be depends in part on UAE ambition. And this is an accounting COP. And, on the one hand, if you want to just have a run-of-the-mill accounting COP, you can make it that. I think the risk is that UAE ambition gets in the way of that, and they sort of try and seek to square the circle in terms of energy transitions and in terms of the role of oil and gas. And that's going to be very difficult. We saw last year when hydrocarbons were critical in terms of ensuring economic disruption was minimized, that, despite that, the criticism of the role of hydrocarbons in the energy transition was still very high. So I think, you can't get away from that. And at this moment in time, the two sides aren't talking to each other. They're talking past each other. So the risk is that you get a COP that highlights that. But I think what Sultan Jaber is trying to do is create that middle ground for a sensible conversation of what will the role of oil and gas be in an energy transition, rather than denying that an energy transition needs to take place.
Okay. Well, the room overwhelmingly thinks that the hydrocarbon industry should have a seat at the table, despite the backtracking by Europeans and some Americans. Jorge, I will leave the final word to you. I'm sure, I'm pretty confident you agree with that, but tell me why.
Well, there is a change in the air. I think the fears, which were very extreme, say 5-10 years ago, are declining. People can see that their lifestyle is not changing year on year, even if you count on a decade. And climate transition is a luxury. You can afford it if you're feeling
luxury.
Yes, you can afford it if you're feeling flush. And in the past year, a lot of people are not feeling flush at all. They're feeling poor. And their desire to participate in more budgetary expense and higher taxes is declining. A politician in the Netherlands already cautioned their parliamentary members that the appetite by the voters had swung the other way. This is clear in many areas. And the oil industry is definitely a part, not in the transition, but in the supply of well-being to the world. So why shouldn't they be part of the discussion? Because if anything, is a balance between the economies that can afford the luxury, the economies that cannot, and the ability of alternative forms of energy and traditional to balance energy demand. So
Okay.
They should be part of the conversation. And if the world decides to exclude them, which could happen by the environmentalists, then they're in a little room talking to each other in what I typically call the echo room. It doesn't solve anything.
Okay. Thank you, Jorge. Energy transition is a luxury, I think, will be one of the quotes that we take away from this. But we've reached the end. Many thanks to the three of you, Rad, Jorge, Adi, Azeba. Great to see you. Interesting discussion that I think, and I hope we'll be back again next week for something just as interesting. Thank you all very much. Goodbye.
Thank you.
Take care. Thank you. Bye-bye.